Hello and welcome to Spotlight. I am Nuong Falong. Now, the Monetary Policy Committee of the Bank of Ghana has stayed the policy rate at 14.5%. Now, they have cited pressures from rising crude oil prices and direct and secondary price effects of revenue measures announced in the 2021 budget. They also cite risks, and I quote, to inflation in the near term, which they believe are broadly balanced. But there are emerging short-term pressures emanating from the rising crude oil prices and the direct and secondary price effects of revenue measures in the budget. Now, the monetary policy will therefore remain vigilant to monitor these risks. The statement was released by the MPC, of course, and they said the global economic recovery is also underway, although there are new variants of the COVID-19 virus, which we have spoken about consistently. That's nothing new. But they believe this is weighing down on the economic activity in the last quarter of 2020. And it is said that global financing conditions will remain benign as major central banks reaffirm the continuation of their asset purchase programs. This will provide continued policy support and improve prospects around the global economy due to ongoing vaccinations efforts and the large fiscal stimulus in the US. So this part is external factors that, of course, affect all of us. So they are expecting that the sustained policy support will minimize the impact of the pandemic, and the massive rollout of the COVID-19 vaccination program in advanced economies will also significantly improve global economic prospects for 2021 in the medium to long term. These we are also expecting to impact the Ghanaian economy positively. So the core of the message here is that the MPC of the BOG have kept the policy rate unchanged. That's at 14.5%. We're going to be assessing the impact of the Monetary Policy Committee's decision on Ghana's economic recovery. As we all know, we are moving into a stage of economic recovery because we have been hit by ravages from COVID-19 globally. Today we are discussing how this is going to affect Ghana's economic growth. And I will be joined by Mr. Emmanuel Wiafe Ejapong. He's an economics lecturer at GIMPA. We'll also be joined by Dr. George Domfe, who is a development economist from the University of Ghana. These two economists will help me look at the MPC's decision and its impact on Ghana's economic recovery. Spotlight will take a quick break, and when we come back, we continue the discussion. Stay with us. Thank you for staying with us. This is still Spotlight on MX24, your destination for fun, fearless, and factual content. Before we went on the break, I mentioned that the MPC's decision to stay the policy rate at 14.5%, of course, has impact on the general economic outlook within the country, and that's what we are assessing tonight. With the help, of course, of an economist who is from the Policy Initiative, Dr. Daniel Mate is an economist from the Policy Initiative. We are also joined by Dr. George Domfe, an economist from the University of Ghana, a development economist. And we are also joined by Emmanuel Wiafe Ejapong, who is an economics lecturer from GIMPA. Gentlemen, welcome to Spotlight.
Thank you.
Now, I just want to first take some explanations for our viewers to understand the premise before we go into the main discussion. So, just a brief education on some interesting terms like the policy rates, reference rate, etc. Mr. Japon,
Yes.
you are the lecturer. Please help us with some education. When we talk about the monetary policy rate, what exactly are we talking about?
So when we talk about the monetary policy rate, it's basically the rate which is set by the Bank of Ghana in our case. So it's the macroeconomic policy laid down by the central bank, and this involves some considerations. Okay, so before they set these rates, they look at the economic conditions that we have in the country, and this will be based on some conditions like inflation, growth expectations. Then on the other side, we look at exchange rate expectations. Then they come out with this rate, which is actually an interest rate that the monetary authority sets in order to influence some of these economic variables that I have mentioned.
So when it is stayed, does it mean that things are not going well with the general economy?
It doesn't mean so.
Okay.
So this policy rate is stayed or decreased, or let me say cut or increase, depending on what the general outlook in the near and the short term, medium term, and the long term. So in the immediate time, let's say in the next 3 months, what do we expect globally and in our country? So one key thing that when you read the release, you realize that there is a hint that inflation is picking up across the developing economies as well as some emerging economies. And what this means is that we are kind of import finished products from there. So there's likelihood that we are going to import some of these inflationary pressures onto us. Then again, in your introduction, you mentioned the crude price pressures. So these are kind of sending signals for the economy alongside what we are going to spend in our country, along the taxes that we have, that the government has imposed on some aspects of our economy. This, you realize that is sending signals for price pressures. And looking at how our economy is and how we can accommodate, then that informs the bank to maintain the rate for us for this short term, so the next announcement will be made.
Right. Now, let's look at the Ghana reference rate. Now, we know what we mean when we talk about the monetary policy rate, as explained by you. What does the Ghana reference rate then mean?
So the reference rate, let's think about it in simple terms as a benchmark at which our commercial banks would then benchmark their interest rate on when you go and borrow, when you save, when you are buying something like treasury bills. This reference point becomes a benchmark. And this reference point is determined, particularly in our country, we base on the treasury bill rate is one of the components that go in. And so when the reference rate is reduced, when you are going to lend, or if you are a borrower, you should expect that the lending rate is going to reduce a bit for you. If the reference rate is going up, you should expect that when you go to a commercial bank, you should expect that the rates at which you are going to borrow will also go up. So reference rate is just like a benchmark at which the commercial banks will then base on that rate, assess risk and profit margin.
So the reference rate and the lending rates are essentially connected.
Yes, they are essentially connected. So the reference rate will inform the lending rate or what rate that we are going to have.
So the reference rate informs the lending rate, and what informs the interest rate?
So good. So when you are talking about interest rate, we use interest rate in general. So when you say interest rate, it could be interest rate on your savings, interest rate on the amount you have borrowed from a bank. So when you are looking at this interest rate, the first thing the banks will look, especially when you are going to borrow, is the level of risk that is involved. So you have some risk margin, then they will also add certain level of profit margin on the transactions that you are going to have. This now comes out as the lending rate. So, and the savings rate, which is also lower, when I compare lending and rate on your savings, the savings rate is lower, but also they look at the profitability of the activities that our monies that we have deposited with the banks are going to yield, and they determine the interest rate on our deposit or our savings for us. So interest rate is more like a general term covering any interest that you earn with the bank.
Thank you for that, Mr. Wiafie Japong. Let me go to Dr. Domfe, who is also on the line. He just joined us on Zoom. Also, Daniel Mate is with us on Zoom. I'll come to you shortly, Mr. Mate. But Dr. Domfe, let's look at how the interest rate is determined. What do banks consider before they peg their interest rate? Is it just about the policy rate, or are they considering other factors within even the banking environment before they set the interest rate?
Thank you very much, my dear sister. And let me say good afternoon to our cherished viewers, and also to the panelists. I want to say good afternoon to you all. Yes, so the question is, what do banks normally consider before they peg their lending rate? There are quite a number of things that they consider, but the most significant among all of them is what is called policy rate. When we say policy rate, that is the rate at which the central bank lends to the commercial banks. And so the banks are in the business of buying and selling. They go to, I'm technically speaking, they go to the central bank to borrow. And when they borrow, they also sell to their customers. And because they have to make profit, they always want to look at the price that the central bank makes the money available to them. And that is why we call a policy rate as a discount rate in some jurisdictions, sometimes prime rate in some jurisdictions, and it's the mother of all interest rates, because that is what determines what the banks will give, and that also even affect all other rates and interest rates in other businesses. And so I said that the very first thing that the banks will normally consider before they set their lending rate is the policy rate that always is announced by the central bank. In our case, I'm the Bank of Ghana, and today we hear the last time they maintained it at 14.5%. Because it is 14.5%, that is definitely going to drive the lending rate. And yesterday during our discussions, we talked about the fact that the year 2016, policy rate was 26.5%, and because of that, average lending rate was 32%. Today, that it has dropped or declined, as it were, to 14.5. We have seen the lending rate also
come down,
being dragged along, to 21, to suggest that anytime the policy rate goes down, it has influence. It has influence on the dictate or the direction of the lending rate, and so that is the first thing we consider. Now, the second thing that is very important that many people don't always look at is what we call the bank risk ratio. Bank risk ratio. And when we say bank risk ratio, we're talking about the risk of doing business, the risk of doing business between the banks and then the customers. Anytime you hear bank risk ratio is 20%, it simply means that if 100 people go to bank to borrow, 20 of them are likely to run away. Let me repeat that. If we say bank risk ratio is 20%, it simply means that if 100 people go to bank to borrow, 20 of them are likely to run away.
Which means there
And
will
so
be
if the risk ratio is higher.
So there's a high possibility of bad loans.
Yeah, if the risk ratio is exactly. That would, contribute to the bank non-performing assets, the bad loan, as you rightly put it. And so when the risk factor is higher, the banks would also want to be careful. When it doesn't matter even if the policy.
We technical connection there is not too good, but we'll be trying Dr. Domfe again. He's going to join us right back. We have Daniel Marty, who is an economist at the Policy Initiative. Daniel, are you with us?
Yes.
Yes, if you can just pick up from where Dr. Domfe, his connection froze over there, and explain further to us.
Right, thank you very much.
So he was talking about risk, yes.
The risk element in pricing the loan facility or in determining the lending rate or the interest rate, the banks will look at the risk factor. I think Doc has used the term in a more simplistic manner that the people will run away. Not necessarily running away, but the possibility of them not meeting repayment obligation after when they fall due. What it means is that once the facility is given to the client, by virtue of the sector within which he or she finds himself, or the nature of his business activity, there's that propensity of him not being able to meet repayment obligation per schedule, and that may constitute the risk. So at times, not necessarily the business person or the individual who has gone for the facility running, but is there. The bank can visit him at any time, but the point is that his business will not have the capacity to generate sufficient inflow to be able to meet repayment obligation, and that is where the bad debt, just like he rightly put it, comes up with. Now, so they consider that, and to explain further, what it means is that you and I can go to a bank for a facility, the same bank, and you may be given a rate lower than that which will be given to me because of the sector within which you find yourself, number one, because of your credit history, number two, and thirdly, the overall performance of the economy. So, for instance, if I am dealing in eggs, I buy L in large quantities and I supply, and you are selling beans. Eggs have a higher risk because of the fragile nature of that product. In an unlikely event, let's say an accident or whatever, you are likely to lose everything. So the person dealing in eggs is likely, the banks are likely to give him a higher interest rate as compared to the person dealing in beans, right? So these are some of the factors that are considered. First, the person, his relationship with the bank, number one,
Mr. Marty,
his credit history, and the nature of the business, and the overall economic performance of the country at any point in time. So these are some of the things that constitute, that are considered when pricing the risk factor in the determination of a lending rate or the interest rate for that matter.
Mr. Marty, let me just hold you there for a bit. Now that we seem to have established that different customers may end up with different rates when they approach a bank for the same facility, how do I, as a customer, ensure that I am attracting a better rate?
Yes, number one, your financial literacy is very important, or your basic understanding about what the bank does is very important. And if you don't have it, you need to engage an expert to guide you. So, for instance, if you are in the business, you need to understand the nature of the banking sector, what they do, what they are looking out for, and you could be guided by financial analysts and accountants to help you. So, for instance, the two of us can go to the same bank, and I may negotiate a better rate because of my understanding. Number one, I've been dealing with the bank over a period of time, and looking at the nature of my operations with the bank, I should be able to tell them, look, I've been with you for the past 5 years. I've done ABCD with you. You can look at my track record in terms of my operations, and I can even establish the fact that maybe 2 years ago you gave me this facility. I was able to pay before schedule, or I've paid on schedule, or I've never defaulted in meeting my repayment obligation as and when they fall due. So I can argue my case, taking these factors into consideration, and I may end up getting a better rate than you, maybe even having a huge quantum with a bank, but your lack of understanding to negotiate may end up you paying a higher rate. So the understanding of the operations of the banking and the financial sector, for that matter, is very key and critical. So where you don't have that expertise, you need to engage people who have it, and they will guide you to be able to get a very good rate for that matter.
Thank you so much, Mr. Nim. Let me just go to Mr. Wiafe, who is still on the line, and let him give us his take on that. How can customers attract a more favorable interest rate? We have just been told that you need to have some amount of financial literacy. But a lot of people who approach the banks have no basic understanding of their finances and how to negotiate. Should you be presenting a certain profile to show that you are risk worthy and then therefore attract a lower interest rate?
Right. Thank you. What I think you should do when you are approaching a bank for a facility or a loan is you yourself, you have to be able to prove your financial flows. Okay, so if the bank is, you are able to establish that you have consistent flow of income of the bank, without, aside your financial literacy, you should be able to argue your case out that over a certain period of time you have consistent flow, and you have to also be able to prove that for the period that you are going to have that facility, you, at least if there is certain amount of risk of you not being able to finance that loan that you are taking, that risk is at the barest minimum point. So if I approach a bank, for me, I am a salaried worker, and they know that every month my salary is going to hit the account and it serves as a guarantee. I am likely to get a lower rate than someone who does not have that consistent flow of income, at least for the projected number of period that you are going to get the facility for. And that is why our market women go to the bank and they are charged higher rate of interest, because the bank cannot really ascertain whether they will have a consistent flow of income to the bank. And that in itself presents some amount of risk to the bank in order whether you are going to be able to pay the loan or you are going to default.
This is quite pretty insightful. But let's look at the announcement and the maintaining of the policy rate at 14.5%. Is this something that was expected from most economists, or did you expect a different outcome from that meeting?
Well, for me, looking at our economic setup, I for one was not expecting any change if there is going to be change. Because right at the outset of this year, the second month and the third month that we are in and we are going to the end is showing some level of uncertainty. And in terms of our revenue flow, already because the U.S. economy is trying to adjust and their interest rates, their short-term yield rate is going up. Gold prices started to slump a bit, I think about 3%. So the forecast for the first quarter, already we are a bit behind in terms of our trade balance. And this kind of uncertainty is likely to permeate through the year. So for me, for this first quarter, maintaining the rates for me is good. The second thing that I looked out for is the fact that we are hinted that prices in the advanced economies are going up, or inflation is started to surge there. And the implication is that whatever we go and import, let's say we go to China and import from China, we are bringing that price into our country. And we are setting the monetary policy again so that in the end we have a stable economy. And once we have this expectation that prices are going to go up, one of the ways to help protect ourselves is to keep the rate at where it is, so that in any case, when there is that kind of imported inflation, in our economy, the liquidity level will not affect us so much that it will lead to an escalated inflation that we cannot control.
Thank you, Mr. Wiafe Ejapong, for that submission. We have been joined again by Dr. George Domfe, who we lost earlier on the line. Dr. Domfe, can you hear me? Dr. Domfe? If you can hear me, please unmute yourself so we can hear you. I don't think the connection there is still very reliable yet. But we're going to keep trying to get to Dr. George Domfe. In the meantime, Dr. Domfe, hello?
Yeah, hello, my dear.
Yes, I can hear you now. I'm not sure about the connection yet. Dr. Domfe, can you hear me, please? Yes, there's a heavy shake there. Still very unstable internet, unfortunately, because usually we have a very good connection with Dr. George Domfe. So, Mr. Mate, are you still on the line?
Yes, please.
Fantastic. So, before the announcement by the Monetary Policy Committee, were you expecting a maintenance of the policy rate? Were you expecting a reduction or an increase? And what specific economic variables informed your expectation?
Yeah, thank you very much. I think prior to the announcement, a couple of radio stations have sought for my view. I was interviewed with respect to my perspective, and I did establish that BOG should maintain the policy rate at 14.5. And my reason basically has to...
You have 1 minute remaining.
The essence of monetary policy is basically to control inflation and economy. And my reason was that if you look at the behavior of inflation, 9.9, and in February it moved to about 10.3%, and we are now recovering, and the macroeconomic environment is stable as expected. And it will be fatal for BOG to just jump by reducing the policy rate. So the best thing to do is that you just make.
Thank you so much, Mr. Enim. I'm going to come back to you there for a continuation of that question. But Dr. Domfe is back on the line with us. Hello, Dr. Domfe.
Yes, my dear sister.
Yes, this is.
Can you hear me now?
Hello, my dear brother.
Okay.
This is very clear now. Dr. Domfe, so I was just.
Yeah, I'm home, and then.
I was just trying to find out from you if prior to the announcement by the MPC, you had a different expectation, or your expectation aligns with their announcement, and what variables informed that expectation for you?
That expectation, okay. Thank you very much. But before I come to that, I know I was explaining, I was giving elementary definition, the street man's definition to bank risk ratio. Sometimes when you are speaking to the media, you don't use the technical jargons that we used to teach our children in school. And so when I say bank risk ratio is 20%, to the layman, and that's how it is. It means that if 100 people come to the bank for loan, 20 are likely, that is potentially
default,
20 may not be able to pay. And that is what I was explaining. The speaker who came later was trying to add more definition to that. And we all recall that Ghana, somewhere around 2006, banks were rushing after people to come and take loan. The issue here was that at that time, bank risk ratio was 1.7%. And that happened to be one of the lowest in our economic history, 2005, 2004, thereabout. And so you saw the banks now going out to encourage people to come and take loan because the bank risk ratio had gone down to almost 1%, and it was historical. And so they thought that this time, if we give the money to you,
more likely to pay
the possibility that you will pay is very high, and so that goes into the lending rate, as I say. But and the speaker who spoke after me did very well, explaining that the lending rate is specific. Every bank will look at sectors. We have the manufacturing sector, we have the primary sector, agricultural sector, and we have the tertiary sector. So they look at the sector where you are coming from. If you are a business person, the risk associated with your sector, and they determine your lending rate. So the lending rates are specific, are sector specific, and business specific, depending on where you are coming from. Now, the second question, whether the 14.5 was okay. Yes, I do also agree with the last speaker that, in fact, if I were with the Bank of Ghana, that is what I would have suggested, that we have to maintain it at 14.5 for this reason. For this reason, and let me say, yesterday I explained that we are now in inflation targeting regime, and in the inflation targeting regime, you want prices of your goods to be within the reach of poor. In Ghana, as for that matter, you don't want prices to go up. If lending rate, you reduce your policy rate to now it is 14.5, assuming they had reduced it. These are some of the things that could have come. The moment it comes down, the banks are in competition, the commercial banks, they are in competition, so definitely they will also reduce their lending rate. If they reduce the lending rate, it means that money is going to be available, more money is going to be available to the people, so many people will go and take money. Fine, some of them may use it to do businesses that would encourage the economy to grow.
And
but
some
if
that
rate is not realistic to reflect the prevailing market circumstances, then definitely people will buy things that they are not supposed to buy. And people who have gotten so much money, so they will be in queue to make demand. Aggregate demand will go over the market, dictates. And when that happens, prices will go up, because when people see that a lot of guys are in queue, I'm a seller, and I see people are in queue, they want to buy the little that I have. I don't have much. The little that I have, so many people are ready to buy it. Then immediately I will increase the price, and inflation will go up. And that is why the bank shouldn't, it wasn't prudent for economically to reduce the rate, lower the 14.5. If that has happened, prices would have gone up and inflation would have gone up. If you want to check inflation, what do? That is when you look at the market, the production. How many people are producing cassava? How many people are producing yam? You know, they check all those things. If at any time an inflation is now, we have what we call the non-food and food. And so you look at the food, what is it that is pushing the food? So if you look at all these conditions and it is not so right that people are producing so much, then you have to be careful when you are pegging your policy rate. You don't want to reduce it, because if you reduce it so much, and the quantity of food and the other essential services provided are not enough, people are going to have so much money to chase those few goods available. And that will push prices higher unnecessarily.
Thank you, Dr. Domfe. And what Dr. Domfe is explaining here, let me be very simple in my breakdown. He is speaking about inflation targeting. Now, when the system is practicing an inflation targeting regime, then there's essentially trying to control inflation and keep it from going overboard. Now, when you're trying to control inflation and keep it from going overboard, you avoid a situation where there's too much money in the hands of people chasing, we call it too much money chasing very few goods. Because if you hold supply constant, which is the amount of goods that you have available, and then suddenly you have the policy rates has dropped, probably too low, and now lending is very cheap, I mean, for people, it means you have more people going for loans. And when more people go for loans, and not all of them are using the money they have gone for productively. I mean, those who can use it productively, usually the private sector who are pushing that into production. But when you have private people who just push that money into demanding more and more of goods and services, the demand will definitely exceed what is the supply that's presently available in the system. When that happens, price automatically rises because too many people are chasing the same thing. And how does that thing become available? By increasing its price. So it becomes who can afford more goes for that item. And when that happens, price is simply shooting up, and then you're defeating the whole inflation thing. So in trying to avoid that, it is more prudent to stay the policy rate. Mr. Japong.
Yes, please.
It's good that you're back because you were also just talking about inflation. So if you can finish up on your previous explanation, and then I can get back to Dr. Domfe.
So what I was trying to say with the inflation level is twofold. So I finished with the fact that we import and prices at the countries that we import from are surging. And it's good that Dr. Domfe also has explained the Ghanaian situation here. So when we have these situations, then I wouldn't expect the central bank to change the rate. Because one thing is, as you just rightly explained, what we need to do is to make sure that our prices does not go overboard. And when Dr. Domfe was speaking, you realize that the food inflation, you made mention of the food inflation, which, of course, most of us, we go to the bank to borrow for consumption purposes. And if money from the bank becomes cheaper for us, then we are going to outrun the supply in the market. And inflation is going to escalate, which will not be good for us, given the signals that are coming from the international side also for the country.
While we're on that, let me just quickly find out from you, what is the entire role of this MPC in Ghana's economic recovery, now that we are in a period of economic recovery?
So I will say that the MPC's role, for me, I think, is to be the balancing agent here.
Okay.
So we know that government is going to spend, and too much spending by the government is also likely to cause inflation for us. So once government is spending, we are also going to borrow. So the MPC or would be to use the monetary policy rate to control or balance the act by the government, by the private sector in terms of borrowing, by government in terms of borrowing, so that we maintain or we just operate within the threshold of inflation that we have set for ourselves for the year, at least what we have targeted for the year. Whether we go +2 or +1, then we know that we are within. Otherwise, if there is too much spending and we are not able to control inflation rates through the MPC's decisions and acts, we are looking at also running down the economy.
But Mr. Japon, were the reasons of the committee for maintaining the policy rate sufficient?
I believe they are. So, you see, we are in a period of recovery. So, when you are making some of these decisions, you have to be tactful enough. You have to understand. A lot of people want the rates to go down so that we can walk to the bank and we borrow because the bank rates are going to go down. But that is not as simple as that. That is what Dr. Donfe was explaining to us. That when that happens, we are going to have problems with inflation. And when we have problems with inflation, it is going to send a signal that our macroeconomy is not stable. So the reasons that they give, using the medium term and the long term, is enough for us to maintain the rate at what it is now.
Mr. Japon, so I understand this part of trying to avoid a shoot up in prices, which would destabilize inflation. Now, but on the other hand, we're also trying to drive economic growth, aren't we? And the maintenance of the policy rate, wouldn't that conflict with the ability of the private sector to get more loans and to be able to invest in businesses?
I don't think it will conflict. And the simple reason is so we are talking about the Bank of Ghana MPC, but on the other hand also, government is also coming up with policies to cushion the private sector. Then that is why I'm saying that the MPC will be acting like the balancing agent in the economy now. So the rates that we have now, I think that because we are on a path of recovery, and given that I think now the average lending rate by banks is around 21-22%. Compared to previous years, even in this period of pandemic, I think this rate is far lower, although not low compared to other countries and other developing countries and advanced economies. I believe our system, our economic setup can accommodate these rates that our banks are charging. And our private sector will also get the support that they need in terms of government giving them some facility or assistance through these different organizations in our country to support our small-scale enterprises.
Mr. Japon, just quickly before you go, can you just give us your closing remarks on the policy rate and the economic situation and the prospects for growth going forward?
I believe that with the hope that we are going to get more people vaccinated from June onwards, I think it is going to send a good signal for us as an economy, and it will bring back the confidence in doing business. With that said, given the current policy rates, I believe that if we are supportive in our acts and go by what the government has instituted, and we support all the policies, and we work hard as a people who have Ghana at heart, we are going to get out and recover very fast. The rate that has been given for us, I think, will help us on our path for growth and maintain macro stability, which will also send a good signal for business within the business community, both local and international, to invest in the economy.
Very insightful contribution there from Mr. Emmanuel Wiafi Ejapong. Emmanuel Wiafi Ejapong is an economist and lecturer at the Ghana Institute for Management and Public Administration, GIMPA, and he was just giving us a summary of his expectations for growth in the short to medium term, and he thinks that we are, properly positioned to spur growth, especially in the private sector, even with the maintenance of the policy rate at 14.5%. He is particularly pleased with the maintenance of the policy rate because he believes that as we are maintaining and promoting inflation targeting, then we need to be controlling the policy rate to ensure that we are not pushing too much money into the system and creating a situation of creating a situation of demand overriding supply and pushing prices up. We have Dr. George Domfe back on the line. Welcome back, Dr. Domfe. Hello, Dr. Domfe, are you with us? Dr. Domfe's line is still unreliable. We're having quite some problems with technology today. But if you just joined us, we are discussing the maintenance of the policy rate at 14.5%, which was announced by the Monetary Policy Committee. Some people expected the policy rate to be increased, some expected it to be reduced, but most economists, as we are hearing, expected it to be maintained due to other factors that they observed within the economy and other external factors. This is Spotlight on MX24. We'll take a quick break, and when we come back, we continue the discussion. Stay with us. Welcome back to Spotlight. Today we are discussing the maintenance of the policy rate at 14.5% and its impact on economic growth and how it's going to affect the economic outlook of Ghana going into the short to medium term. On the line, we presently have Dr. George Domfe and Daniel Marty. We also had Emmanuel Wiafi Ejapong earlier, but he just summarized with us and went off the line there. He is a lecturer at the GIMPA. He's a lecturer at the Ghana Institute of Management and Policy Administration, GIMPA. Dr. George Domfe is a development economist at the University of Ghana, and Daniel Marty is an economist from the Policy Initiative. Dr. Domfe, can you hear me now?
Yeah, I can hear you loud and clear.
Okay, I can also hear you very loud and clear. Now, I was just asking you how you think the policy rate will affect economic growth going forward.
Yeah, so our policy rate, even though today we say it is 14.5, it is still very, very high. And that is something I want everybody to understand. It is still very, very high. If you go to the developed world, as we talked today, policy rates hover around, policy rates in those countries hover around 4%. And if your policy rate is
Dr. Domfe,
4%, then
let me just
trust me, the
interject.
lending.
Let me just interject a little there. You're talking of developed countries, but we know some of our neighbors also have their policy rate lower than ours, don't we?
Exactly. Even Cote d'Ivoire is doing far better than Ghana. Cote d'Ivoire is doing far better than Ghana. So, my sister, our policy rate is very high. It doesn't support businesses. I tell you, the one district, one factory would have been much more successful had it not been for the higher, policy rate or higher interest rates in Ghana. Last year I had one individual, Dr. Atta. He is in today's one district, one factory, and he has set up a very huge starch factory somewhere in central region. And this is an individual who stayed US for almost 30 years, and he has come back home to help. I brought him to my class to tell us whether the one district, one factory is a reality. And so he came to share his story with us. The very thing that he said that was a stumbling block happened to be the interest rate. According to him, because of the higher interest rates in Ghana, he had to go all the way to China with the assistance of Ghana government. Went to China to procure loan at interest of 8%. In Ghana, no bank can afford to give it to you at that rate because the policy rate is even 14.5. And so that is very high. That does not support development. If you really want to create jobs, if you really want to grow our economy, the policy rate should go low. Should go something below 5%. If that happens, you see the lending rate also moving around 1%. And the implication here is that when an individual goes to bank to borrow 100 million Ghana cedis to work today, that person every year, if he has to pay back everything to the banks, is paying only 1 million. If you go to US today, the lending rate, average lending rate in US is about 2%. What does that mean? It means that if I were in US and I had borrowed $100 million US and I have to pay within a year, I'm going to pay only 2 million or less to the banks. Compared to Ghana, that is 21. And so if you start business, you go for 100 million and at the interest of 21, it will not be sustainable. Before you could say that you have paid almost, or you have given all that money back to the banks. And the next moment, if you are not lucky, the bank will send you to Insawam. And so that does not encourage businesses. But that does not also mean that Ghana government can get up one day and say, I'm going to reduce the lending rate to 5%. No. The rate should be always realistic. And that is why they maintain it at 14.5, because if they had reduced it further, it would have put prices up. And when prices go up, your economy becomes unstable. And that in itself is also not good, right? And so in as much as we want it to come down, you also want to check the prices. And in economics, we have something we call Philip curves. The two issues are very difficult issues. You want your lending rate to come down, or as it were, the policy rate to come down. When it comes down, prices are also going up. And so you have to play in between the two to check the rate at which prices go up, that is the inflation, as well as the production. When the rates are lower, they improve, they help with productivity. And when people are able to produce more, they engage extra hands, we create more jobs, more people work, more people pay taxes, government's internal resource mobilization effort is enhanced, government gets more money, government wouldn't have to rely so much on loans. And so the way to go Ghana Beyond Aid agenda, if you read the document, is to help with the local production. And if you want to increase local production with this level of interest rate, I'm afraid government still needs to work harder. I know they came to meet it at 25.5%, but the 14.5 is still very high. We need to work more to encourage the production. Once the agricultural sector is doing very well, producing more, then government will have that flexibility to reduce it, because in that case, even if you reduce and people get money, they will still get enough to buy, so the producers wouldn't be urged on to increase their prices unnecessarily.
Thank you
The
so
bottom
much.
line for the reduction in lending rate is for the government to work harder to increase local production, the manufacturing sector working hard to produce more goods and services. Services sector producing more services, manufacturing sector producing more goods, agricultural sector producing more goods. And so when the available goods and services are in abundance, then the government can have that space, to reduce the lending rate without pushing up the prices. That is the way to go.
Thank you so much.
Always talking about job creation, job creation.
Thank you so much, Dr. Domfe. I'm going to accept that as your closing remarks because we're running out of time. Very grateful for your time. Very grateful for those explanations there. I'm just going to go to Mr. Marty. If you're still on the line, Mr. Marty. Hello?
Hello.
As we have seen Dr. Domfe explain this, what seems like a conundrum between the policy rate and the risk of pushing inflation out of control. So how do we approach it in a way that we are satisfying our drive to build the private sector and yet not pushing inflation out of control?
Yes, thank you very much. Even before I address it, there's an element of the discussion that ought to be looked at.
Okay.
In fact, BOD can set policy rate at 14.5, but if the banks have so much excess liquidity and they are looking for people to come for that money, the banks may even set the lending rate far below 14.5. That is another aspect of it. Now, the banks are into the business of what? Mobilizing excess liquidity from the public for onward lending. So the principle is that if they have more, they can give it out at a lower rate. And that's the reason which the cleanup sector in the commercial sector is key. What we should be looking at is the effect of that principle of increasing the minimum rate and then the cleanup exercise. If indeed it will really help the banks to mobilize enough liquidity. So the principle is that what BOD is doing is that, look, studying the macroeconomic environment, we have the view that we can give credit to the commercial banks at 14.5. This is what we can do, number one, to control inflation and other variables within the macroeconomic space. So the banks themselves, we should focus on the banks and ensure that the banks grow to a extent where they can mobilize excess liquidity for onward lending. When they have more money as excess liquidity with them, they will be chasing people to come for the loans. If you recall, people used to say during President Kufuor's era, the banks were chasing people for the loan. What it means is that the banks have excess liquidity. They don't know what to do with it, so they are looking for people, business people, to come for that facility, and hence the rate will fall. So if we can focus on that, it's one of the ways of addressing the issue. The banks themselves must be able to grow to understand where they can give facilities to businesses, even far below policy rate, because they have more assets, and the more they give to businesses, the more returns they make. So that is one aspect of the narration that ought to be looked at critically.
Have we ever attained such a situation in Ghana where the banks are setting a rate lower than the policy rate?
Pardon me, come again.
Have we ever attained such a situation in Ghana where the banks have so much excess liquidity that their rate is lower than the policy rate?
No, not really, as I can recall. Okay. Not really. But what I'm saying is that it is one of the ways to ensure that the banks themselves give out loans or extend credit facility to businesses at a very flexible rate. So, but when the banks themselves are tight, they don't have much liquidity, and they have to fall on the Bank of Ghana as a last resort by borrowing from Bank of Ghana. It is then that the policy rate of Bank of Ghana will influence their decision. They have to extend facilities at a particular rate. I don't know whether you are getting the scenario.
I do.
If I have more money and I'm spending my money, I don't have it. But if I have to come to you and borrow money, you won't
then I have to use your rate, yes.
Very well. So that is what we should be looking at. And that is the reason why when people are cited advanced economy, the rate, the policy says no, this, and then the certain developing economy, which theoretically is good. But in practice, there's something that is affecting that, or that is determining that variable to behave in that like manner, which is the banks have excess liquidity. In advanced economies like America and Japan and then the like, it is big companies that go in for facility, right? So the banks have a lot of liquidity. They are looking out for people to come. So what do? The situation compels them to reduce the rate, to induce people to go in for that facility. So we need to grow our financial sector. In fact, in any economy, more importantly, developing economy, if your financial sector is impotent, in quotes, it's not that strong, that robust to be able to support economic activities, you're in trouble. And that's the reason which BOG and by extension the government should focus by ensuring that our banks grow, generate a lot of liquidity to extend to businesses. So once they have that huge excess liquidity, and we must even come up with a policy where the multinationals should save with our banks,
Right.
especially those who operate in the oil sector.
Thank you so much, Mr. Marty. Thank you for your submission.
Right. I'm very grateful.
Very, very grateful. We've run out of time. In fact, we've overrun. You just watched Spotlight on MX24. We discussed the policy rate and its linkage with economic growth in the short to medium term. We were joined by Dr. George Domfe, who is a development economist at the University of Ghana. We're also joined by Emmanuel Wiafe Ejapon. He's an economics lecturer at GIMPA, and Daniel Mate, who is an economist at the Policy Initiative. My name is Nuong Falong. See you again, same time tomorrow, 8:30 to 9:30 p.m. Good evening.